Hi, welcome. In this session, I'd like to talk about how accounting inconsistencies that we've talked about play out in the numbers. And I'd like to focus on the four key accounting inconsistencies I highlighted in the last session. The first is tax rates. The second are contractual commitments that might not be called debt but are effectively debt. The third are capital expenditures that don't take the form of land, building, equipment, physical investments. And finally, I want to talk about how stock-based compensation plays out in financial statements. So let's start with tax rates. I've taken 6 companies here, and the first thing I did was the easy thing. I went to the income statement for each company. I pulled up the taxable income as stated in that income statement and the taxes, and I divided the taxes by the taxable income. What do I get? I get an effective tax rate. Not surprisingly, Peloton, that's not making money, has a 0% tax rate. But if you look across the other companies, you notice a wide variation in tax rates. Netflix pays only 9.5%. Coca-Cola, on the other hand, pays 16.8% and Toyota 29%. HSBC pays almost 35%. Now I'm going to state a couple of generalizations that might or might not always hold. The first is, as companies age, you're going to see effective tax rates kind of move towards marginal tax rates. Netflix is a younger company than Coca-Cola, and you see that reflected. And sometimes, even with mature companies, you can get strange-looking tax rates. Take a look at Dr. Reddy's Labs. I have a negative tax rate. You're saying, how can that be? Because in 2019, Dr. Reddy's actually had got a tax credit that allowed them to collect 1.6 billion from the government, which effectively left them with a negative tax rate. Would I use a negative tax rate going forward? Of course not. But effective tax rates measure accrual income measures of taxable income and taxes. Now, for each of these companies, I also went to the cash flow statement. You're saying, what is that going to tell me? It's going to tell me what these companies actually paid in taxes in 2019. So if you look at Netflix, you'll see a negative cash flow associated with deferred taxes in the income statement of 94 million. What does that mean? The income statement gave me taxes of 195 million, but the statement of cash flow says, look, I paid 94 million more than that. So in effect, I paid 289 million as taxes in 2019. Same with Coca-Cola, 1.8 billion in taxes in 2019, but in the cash flow statement, I'm paying 421 million more in deferred taxes, which gives me a total tax paid of 2.2 billion. If you want to see what your company paid in cash taxes, you got to look at what's in the income statement, but you also have to look at what's in the cash flow statement. Now, incidentally, HSBC and Dr. Reddy's, because of accounting conventions, report statements of cash flows differently. They start with pre-tax income, and then they show the actual cash taxes paid. And take a look at HSBC. Their income statement says they paid 4.6 billion in taxes. But you look at their cash flow statement, they paid only 2.3 billion. In the case of Dr. Reddy's, their income statement shows a cash that they saved 1.6 million taxes, but their cash flow statement says that they actually paid 4.8 billion in taxes. Now, finally, in the balance sheet is the residue of past tax actions. If you look at my 6 companies, 3 have positive deferred, in other words, they have positive numbers, which basically means that your deferred taxes are an asset. And in the case of 3 of my companies, Coca-Cola, Toyota, and HSBC, I get deferred tax liabilities. Now, earlier when I talked about deferred tax assets and liabilities, I said don't look at them the same way you would conventional assets and conventional liabilities. What that means is if I liquidated Netflix today, nobody's paying me 658 million. And if I liquidated Coca-Cola today, I don't owe 2.3 billion. You're saying, so why they reported? There's signals of what these companies will have to pay as taxes in the future. Companies with deferred tax liabilities, you should expect to pay more in taxes in the future. Why? Because you saved on taxes in the past. Companies with deferred tax assets, there's a signal that you're going to get away paying lower taxes in the future. One final point about Peloton. You're saying, where does a deferred tax asset come from? Remember, Peloton is a young company that's never made money. They've had loss after loss after loss. You know where that shows up? As a net operating loss. This is basically a reflection of the tax benefits they're going to get because they've losses accumulated from the past. Now let's move on to non-debt commitments. The key with interest-bearing debt, the reason you consider it is the contractual obligation. You got to make that debt payment in good times, you got to make it in bad times. That's why we worry about debt. Now, if you think about it in those terms, any contractual commitment you've entered into is effectively debt, even if it's not shown as such on the balance sheet. The most common of these contractual commitments tend to be lease commitments, where you sign a lease for 5 years, 10 years, 15 years. You've contractually committed to make that payment. And until 2019, accounting for the most part allowed companies a free pass. If they signed lease agreements, those lease payments were treated as operating expenses, not financing expenses. Something that's never made sense, but in 2019, they fixed that problem. So let's see what's happening to those lease commitments and how that plays out in income statements and balance sheets. And I'm going to use Nordstroms from their 2019 financial statements to take you through the process of how exactly leases get converted to debt and the consequences. Remember, I've been doing this for 30 years, so well before accountants came to this realization, most of us knew that this is what we needed to do. So we go to Nordstrom's financial statements in the footnotes. And they still report this, even though the leases are now treated as debt. They give you the commitments they've entered into already. So in 2020, they've committed to pay $333 million. In 2021, $353 million. Basically, these are contractual commitments they've already entered into. And beyond year 5, which in this case is 2025, they give you a lump sum of all commitments beyond 2025, which is $1,136 million. This is what companies have always reported. Now, if Nordstroms hadn't done it, I'd have converted debt. But in 2019, Nordstroms went through the process of converting into debt. And let me take you through the process. Here's what they did. First, they took the $1,136 million in commitments in year 5, and they spread it out over 5 years. You're saying, why over 5 years? There's a little bit of a judgment call here, but if you look at the amount of payments they have in the first 5, it looks very likely that the $1,136 is not for 1 year, but for many years. So basically, they have $227.2 million every year from 2025 for the next 5 years. So now you have 10 years of lease commitments. They discount those lease commitments back at 4.7%. You're saying, where did the 4.7% come from? That was the accountant's estimate of Nordstrom's pre-tax cost of borrowing based on interest rates in 2019. If you discount those commitments back to today at 4.7%, so the $333 million back 1 year, the $353 million 2 years, etc., all the way through, you get a present value of $2.7 billion. Well, $2.1 billion. If you take the $2.1 billion, that is the present value of lease commitments in the future. Now, you know what accountants have to do in 2019? They now have to bring it on the balance sheet. And you will see this $2.119 billion play out on Nordstrom's balance sheet in 2 places. One is the current portion of that debt. These are the lease payments coming due in the next year, is $244 million, and that shows up under current liabilities. The remaining $1,875 million now shows up as the equivalent of debt on the balance sheet. Now, incidentally, when you decide to treat lease commitments as debt, there's going to be an interest expense, and the accountants have estimated that interest expense to be $582 million. So unlike in prior years, starting in 2019, accountants have had to make this judgment call, bring these lease payments onto the debt, and I think they're doing the right thing. But let's look at the implications of what this does to all the numbers you would see in the financial statements. The obvious one and the most direct one is the debt on your balance sheet is now going to be much higher by the present value of your lease commitments. But balance sheets have an unpleasant requirement. They have to balance. So you know what? You've got to create a counter asset of an exactly equivalent amount. Now, once you create an asset, you've got to depreciate it in future years. You think this is a pain in the neck. You can't take half steps. You've got to go the entire distance. And if you do this, what you say is your operating income is also going to change in years 5. Remember, pre-2019, the entire operating lease expense would have been subtracted out as an operating expense to get to operating income. So now you're going to add back that lease expense, saying I should never have subtracted out. But you're going to subtract out the depreciation you'd have in the leased asset to get to operating income. The net income will not change because in addition to subtracting out the depreciation, you'll also have to subtract out the interest expense. So operating income will change because you'll add back the lease expense and subtract out depreciation, and generally operating income will go up. But net income should not change because it's equity income. It is after operating expenses and financing expenses. And your taxes shouldn't change either because you're replacing one tax deductible expense, an operating lease expense, with 2 interest and depreciation of equivalent amount. Bottom line, debt will go up, assets will go up, operating income will generally go up, net income should not change, and your taxes should not change. Now, of course, the accountants have dealt with leases, but it's only the tip of the iceberg. This is for any contractual commitment. And just to give you a sense of how this would play out with a different kind of commitment, take Netflix. In 2019, they had content commitments that they've entered into with movie producers to show their TV shows or movies in the future. And they break down those commitments in their footnotes, less than a year, 1 to 3 years, 3 to 5. And if that happens, don't make this too complicated. Just take the 1 to 3, divide by 2, and put half of it in year 2, half of it in year 3. It's not worth losing sleep over. But you have contractual commitments of $19.5 billion. Now, unlike leases where accounting standards have caught up, here the rules seem to be different for different companies. Some companies treat the entire expense as an operating expense. They don't show it as an asset. Netflix, though, given how large these commitments are and how big content is as at the core of its business, does show content assets. So it shows $24.5 billion as content assets. If you ask me to link up what their commitments are to how they came up with the assets, I'll have to throw up my hands because there's relatively little transparency here as to how these commitments get converted to assets. They're doing the right thing, but I wish they'd be more transparent about how they do it. Now let's talk about capital expenses. If you go back to the notion that capital expenses are expenses designed to create benefits over many years, there's nothing in that definition that requires that those investments be in physical, tangible assets. They can be in anything. But unfortunately, accounting seems to have two different sets of rules. When you have capital expenditures in physical assets that you can see, tangible assets, it's shown as CapEx on the statement of cash flows, shows up on your assets, and then get depreciated. But if your expenditures are intangible, accounting seems to be all over the place. So let's take the most common of these expenses, R&D. Now, nobody can argue against the notion that R&D is an expense for future years. It's really to get benefits in future years. It should be a CapEx, but it's treated as an operating expense. You're saying, so what? I think by doing it, you're essentially not just misstating your income because you're taking your biggest CapEx and treating it as an operating expense. You're keeping your biggest asset off the books. And it's not just R&D. It's a company relying on human capital, like a consulting firm, and a subscription-based company for the acquisitions of new subscribers. This is, I think, more an issue across companies than it used to be. So I'm going to take you through the process of how, if you wanted to, you could convert an operating expense back into a capital expense. Let's take Amgen, a pharmaceutical company, and let's take R&D at Amgen. So a few years ago, this is almost 12 years ago, I was valuing Amgen, and I had to make this judgment call on how to make R&D into a capital expense. Step one in this process is I have to define the amortizable life for R&D. Remember, amortizable life is how long it takes between the time you do R&D and a commercial product emerges. Now think about it, a pharmaceutical company, the answer to the question, it'll take a really long time. Now it might take 6 years for some companies, 8 for some R&D, 8 for others, 15 for others, and some R&D might never pay off. So I'm going to make a judgment call. I'm going to assume it'll take 10 years. You're saying, why 10? Why not 9? Why not 12? Hey, if you feel strongly about 12, pick 12. It's not going to make a heck of a difference. As long as you recognize that not making an assumption, in other words, saying, look, I don't know what the amortizable life is, so I'm going to treat it as an operating expense, is making an assumption. Then you're assuming the amortizable life is 0 years. I think 10 is more defensible than 0. So first step is take an amortizable life. I'll give away the game. I use between 2 to 10 years. For very small technology companies, maybe software companies, I go with 2 years. For technology companies that have a hardware component, I will go up to 3 to 5 years. Pharmaceutical companies, I go 10 years. Now you say, what do I do with the 10 years? Here's the next step. I go collect R&D expenses for the last 10 years. So the R&D expense for the current year and the last 10 years. Now let's play out what's going to happen now. Remember the R&D expense from 10 years ago, $663 million. If I treated it as a capital expense all the way through, I'd have been writing it off. Let's keep life simple. And let's assume I was writing off 1/10 every year. That R&D expense from 10 years ago, I'm writing off the last 1/10 this year. There's nothing left over. The R&D from 9 years ago, $823 million, I write off 1/10. There's 1/10 left over. The R&D from 8 years ago, I'm writing off 1/10. I have 2/10 left over. Each year, I look at what I write off in the last column and what's left over. If I add up the second column, I come up with a total value of 13.3 billion. You're saying, what is that going to tell me? That tells me how much capital I've invested in R&D over the last 10 years. That's still on my balance sheet. If you look at the last column, 1.694 billion, that would be the amount I'd be writing off, as amortization this year, if I'd been treating R&D correctly all the way through. So here's what's going to happen. My R&D expense of 3.03 billion, which is treated as an operating expense, I'm now going to abandon that practice. I'm going to treat R&D as a capital expense. The amortization is going to be the depreciation of past R&D expenses, 1.694 billion. The unamortized R&D is now going to go to my balance sheet as an asset. So here's how it will play out if you look at the numbers. When I look at the net income or operating income for Amgen, here's what I'm going to do. I'm going to take the stated number, whatever the accountants tell me the income is. I'm going to add back the R&D expense. Think about why, right? I subtracted out the R&D expense to get to that income, but now I'm saying, no, I shouldn't have done it. So I add it back, and then I subtract out the depreciation. What is that going to do? It's going to push up my net income and operating income by almost 1.4 billion. So my company is more profitable than I thought it was. Will that always happen? Not necessarily. It depends on whether your company is growing or stable. In this case, I'm pushing up the income. But that's not all. Remember, now I'm bringing 13.3 billion onto my balance sheet. You know what that's going to do? Because my assets have increased by 13.3 billion, and something has to change on the other side, I'm going to raise my equity. Why? Because this came out of after-tax income. My book equity is going to go up by 13.3 billion. My invested capital is going to go up by 13.3 billion. In the next session, we're going to talk about accounting returns, where you take the income and you divide by what the invested capital is. When you capitalize R&D, you change your view of the company. You change your view on how much it's investing, on how much it's making, and what kind of returns it's making. You're getting a much better sense of what the company does. Finally, let's talk about stock-based compensation. Until 2004, accountants were again all over the place when companies granted options, especially to their employees. They treated those options as essentially worthless. Now, in the last few years, accounting has caught up with reality, which is when you grant options, they make companies show that grant based on the value of the option to restricted stock at the time of the issuance. So you're going to see an expense line item now for stock-based compensation. It can be a pretty large one, especially for young companies. But in the footnotes to financial statements, you also see the residue of past practices on stock-based compensation. You're saying, what are you talking about? Remember, if you keep giving options every year, not only do you have an expense each year, but you're also accumulating this share count, a potential share count. These options can be converted to shares. And in the footnotes, you're going to see how much of a drain or a dead weight that can be on your value. Same thing with restricted stock. If you've granted restricted stock continuously over time, you're going to see that number build up. And that affects your share count, your per share number, earnings, and your per share value. Now, of course, all of these companies try to have their cake and eat it too. They report the stock-based compensation as an expense, lowers their income. And then they have a pro forma income statement that will add it back. So let's take Netflix and let's see that residue effect. Netflix is no longer a young company. It's been around for more than 20 years. It has granted options initially, but now increasingly restricted stock to its employees. But let's focus on the options that Netflix has granted over time. Now, the options they grant this year will show up as an expense. But if you go to the footnotes, they show you the options they granted this year, right? 2.6 million, at least the options equivalent to 2.6 million shares. And they give you the exercise price. But in addition, they also give you the options that are carried over from previous years, 20.9 million shares. That's not penny change. That's going to change your share count. And look at the average exercise price, 124, because many of these options were granted when the stock price was much lower. In fact, there are 5.6 years. These options have a long life, a low exercise price, and a high volatility. What does that mean? When I value Netflix, this is going to hang over my valuation. When we get to the valuation phase, we'll talk about how to bring it in. But while Netflix shows an option expense, just don't stop that, because the options granted in the past will have to play out. in the value that you attach per share to Netflix. And as I said, companies like to have their cake and eat it too. If you look at Peloton's prospectus, in the prospectus, they have a pro forma statement, an adjusted EBITDA, adjusted for what? God only knows what. The biggest adjustment you see in each of the 3 years is they've added back stock-based compensation. Now you can see the logic here, right? They're saying it's not a cash expense, so I'm adding it back to get the adjusted EBITDA. But they're leaving this illusion that it's like depreciation. I'm just adding it back. But it's not like depreciation. They've given away a share of your company. So we need to be much more careful about stock-based compensation. And personally, I don't think we should be adding back stock-based compensation to get to cash flows, because grants in kind are very different from non-cash expenses. And that's what stock-based compensation becomes. It's grants in kind. So here's the bottom line. Accounting statements are just raw material that you and I use in finance. If we start with that perspective, we have the right, in fact, we have the obligation to mold that raw material to fit our own needs. That's why I have absolutely no qualms about going in and redoing the accounting to reflect my priorities. But that's not to say that when we do that, we will not get different numbers. In fact, we will get different numbers. That's why we do it. We'll get different numbers for earnings and invested capital and even share count. But I'm going to argue that the different numbers we get are more realistic judgments on what the company looks like now than what the accountant tells you. And finally, don't fall for the delusion that until accountants come to their senses, markets are blind. In fact, in 2019, accountants made a big deal about them coming, their come to Jesus moment, where they said, we're going to treat leases as debt. And they acted like markets were going to be surprised. You know what markets did? They blew them off. They said, we knew this already. We've been doing this for 30 years. Markets come to their senses a lot sooner than accountants. So while I make a big deal about R&D, guess what? Markets have moved on. They're already treating R&D as a capital expense, which partly explains the high multiples of earnings you often see technology companies trade at. So think about that as you look at these companies. Accountants make mistakes. They make judgments that reflect their priorities, but their priorities do not have to be yours. I hope you found the session useful, and thank you very much for listening.